Good afternoon, guys. About 2:15, December 27th, Wednesday. Hope everybody's well. All three markets actually did well today, leading with the Dow Jones up 111 points, 0.3%. The Nasdaq up about 16.16%, 24 points, and the S&P 500 about 7 points up. So good continuation. Again, low volume. One of the companies that showed up on the radar is a company called NCino, NCINO. NCNO is the ticker symbol. And what they do is they make software as a service, cloud-based solutions for small banks, credit unions, to be able to streamline their banking operations. So if you look at the very small credit unions and banks with 30 million or so in assets, all the way up to 2 trillion in assets, sorry, 2 billion in assets, they tend to largely use very old systems. And moving to the cloud with a streamlined operation ability to offer more service to their clients is very valuable. Some of the other companies that do this is one of the companies is Blend Labs. They make software that allows a lot of these banks to be able to streamline and understand who to make loans to. So they are a loan management, loan AI assessment company, very similar to UPST Upstart, another company that you might have heard of. So Blend Labs, UPST, NCino, they kind of operate in the same space, though directly don't compete with each other. There are a few other competitors to NCino anyway. NCino went public quite a while ago. They went public somewhere in the 2020 timeframe and have gone through a series of challenges. Let's go through a 5-step process to find out why they showed up on the radar screen, and then we'll kind of assess what we should do with the stock. So start always with the annual income statement. Company did about 60 million in 2017. And then nearly 6-7 years hence, they're about nearly 6.5 times, about 400 million. Not bad. This is pretty good growth. From 50%, 30% now, they seem to have grown faster in 2022, though 2023 seems to be much, much slower. So that's a little bit of a challenge. It seems to be that they've slowed down a little bit. Gross profit in the 50% range, and then they don't have net profit to speak of. And actually, remember, the amount of their losses is increasing. That's not a very good sign. So they have decent but not great profitability and growth. Okay, so total revenue has actually dropped from the 40-50% down to the 20 to the teens percent. That's not a good sign. It's actually slowing down even further. Gross profit again in the 60% range. Net profit actually has been mostly, well, it's gotten a little better from the last year, where it was in the 30 million per quarter loss to the teens loss. $10 million in loss. So they have about $65 million loss in the trailing 12 months, which should probably be in the 40 to 45 million, 60 million range in the next 12 months. So growth is okay in the teens. Profitability is non-existent, so not terrific. Assets-wise, they have about $1 billion. Okay, so they don't have a lot in current assets. What do they have $1 billion in? Intangible. Okay, so they have about $100 million in total assets and about 60 cash assets and about 60 million debt. Manageable, but they have a lot of goodwill. The cash flow seems okay. So they definitely seem to be able to manage the cash flow for the debt that they have. So for a company doing 15% revenue growth quarter over quarter, 8 is a little bit high. I would have liked to see it in the 6 range, but this is a little bit high. So they seem to have gotten much, much better over the last couple of quarters, at least in terms of their valuation. Again, 50%, 48 to 50% gross margin, negative 13% net margins would probably get a little bit better. If you look at it from an annualized perspective, it gives you a better sense. They've gotten a lot of money. They've started to lose less money, and their gross margins have stabilized in the 50% range. So on a scale of 1 to 10, this fundamentals looks more like a 6. That's being generous. Okay, so let's look at the long-term technical trends perspective first. On the monthly chart, they're mostly just getting out of a range. So this seems to be forming a base. You could call it forming a base in one sense. This is a very long, big base that they've been building. Or in another sense, you could just say they're range bound. So they're still building a base. This is not going much beyond the base, but seems to have gotten through quite a few of the resistances that existed for the year. If you look at it, this was a big resistance, but still range building. This is a stage 4 markdown. This looks more like a stage 1 accumulation. Okay, on the weekly chart, the accumulation becomes more profound. If you look at it in the last 1 year, they've really gotten, okay, so that's the reason why it's showing up. They're at a 52-week high. This is December, let's see. This is January of 2023. So this is a 52-week high. That's one of the reasons why they're showing up. They still have a lot of resistance. So if you had to draw resistance lines, it's probably going to be the first resistance line is going to be somewhere in the 38 zone. So they're going to hit against that resistance. But my feeling is I don't think they're necessarily going to make it all the way up there to the 38 zone because they've had 4 weeks consistently of very good up and move. So this 4 weeks of up to move should probably translate to about 20 sessions or so on the daily chart. Still base building, resistance at 38, 5 points, about 15% from here. Seems like the possible likely choice. Look at that. This has been a strong channel, just consistently going up and to the right. Good for them on the daily chart. Hasn't quite built. So you could call this technically, if you had to go here and draw it until here, and then draw the handle, gotten out of the handle, and now they're moving up into the right. That's the view. So if you go back to the weekly chart, it'll show you very clearly cup, handle, move up. So that seems like the most likely reason why they seem to be going up into the right quite a bit. And they've hit a 52-week high, as I showed you on the chart. Quite a bit of resistance overcome in the 33.72 zone. This is very close. I still wouldn't call it a complete breakout. This is a very strong move up. Look at the previous operationally movement of the chart, right? So they've this is a very strong after earnings kind of move, a little bit after earnings move, did a very strong 25-30% move up and then up into the right. So they had a very bad earnings drawdown. I'm not sure when that was, but they had some very good moves after earnings as well. So this was a big drop down and then a bull flag, move up, move a flag up, move down, another bull flag that just consistently went down, consolidation stage 1, and then stage 2 markup. So most likely they could go to 38, but this is most likely going to hit the 33.80, 33.84 zone and probably head down, is my sense. They'll do okay, but this doesn't look like it wants to go up a lot more. The volume seems to be tapering off. So that's one key part. Let's look at the volume. Usually, compared to what the usual volume is, this is very, very low. This is going downwards. Look at that. So that's not necessarily a good sign. And it's hitting to the top end of the RSI. The moving averages are all pointing up and to the right. So there may be a little bit more room, but not much more room is my sense. This is a good sign. The MACD curling up is a good sign. So there is diverging signals coming up. On one hand, I'm seeing that they hit 52-week high. So it's likely going to go up a little bit more. Whether that is to the 35 or the 34, I'm not sure, but this is a sign that they want to give up. This is a sign that wants to continue. So it's a little bit of a diverging signal on NCNO. I'm not going to take a trade, but if you want to make sure that you keep your stop losses very tight because this has a tendency to be able to go down at least all the way down to back to where the 20 moving average is 31. So this has a nearly 6 to 8% move down likely if January gets a little bit tough in terms of trying to take a break from nearly 2 months of going up. The stock seems also okay. Margins are okay, 50% margins. Net margins getting a little bit better, losing less money. NCNO is a stock, software as a service company. Not as good margins as other SaaS companies, so still be cautious, but overall decent company, NCNO. Thank you. Please subscribe and follow.